Biggest risk in crypto is behavioral risk. And when you start going above 5% Bitcoin, historically, Bitcoin becomes the driver of what's called the maximum drawdown of your portfolio. That's when your portfolio goes from looking great to looking pretty poor during a big market pullback. And in our experience, when Bitcoin starts to be the tail that's wagging the dog of your portfolio, people panic when you have pullbacks. Again, this is a very volatile asset. It's had multiple 50% plus pullbacks. If you put too much of it in your portfolio and we get another one of those pullbacks and you sell at the bottom, then you've done real harm to your portfolios.
Matt Hougan begins by advocating for a starting point of at least a 2% allocation to Bitcoin in an investment portfolio. He compares Bitcoin, a $2 trillion global asset, to equities, which total approximately $100 trillion. From a benchmarking perspective, this allocation aligns with the global portfolio of assets. Holding less than 1 to 2% effectively makes investors underweight Bitcoin relative to the benchmark, essentially equating to a short position on this transformative asset. Extensive studies reveal that adding Bitcoin to a portfolio enhances risk-adjusted returns as measured by the Sharpe and Sortino ratios. These improvements persist up to an allocation of 5%, beyond which the portfolio's maximum drawdown risk becomes significant.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I'd say the starting point is at least 2%. If you think about Bitcoin, it's a $2 trillion asset. Globally, equities are about $100 trillion. From a benchmarking perspective, that gets you to an allocation of 1 to 2%, depending on how much equity you have. And that's just a starting point. If you're below 1 or 2%, I'd argue that you're effectively short Bitcoin versus your benchmark.
How did you come up with this 2% number?
Yeah, I think there are two ways to approach it. So one is that benchmarking exercise, which is just the starting point for most investors should be matching the benchmark of the global portfolio of assets. And again, Bitcoin has emerged as a multi-trillion-dollar asset. So if you have an allocation of 0, you're underweight versus the benchmark. 2% gets you up to neutral. So that's one way to approach it. The other way to approach it is, we've done an extensive study of the impact Bitcoin has in a portfolio over long periods of time, looking at all available data. And what that data shows is that you can improve your Sharpe ratio, improve your Sortino ratio, improve your risk-adjusted returns by adding more and more Bitcoin to the portfolio. Those studies actually suggest that up to about 5% of your overall portfolio, you're getting historically what amounts to a free lunch, which is higher returns with no additional or low additional volatility. From a portfolio construction perspective, I can make the argument up to about 5%, but from a benchmarking perception, 2%, but certainly not 0%. It's really interesting when you look at what would have happened if you added 1, 2, 3, 5% Bitcoin to a portfolio historically. A lot of people think of Bitcoin as this extremely volatile asset, extremely risky, which is true. It is itself very volatile. But because Bitcoin moves differently than stocks and bonds, because it has what's called a low correlation to stocks and bonds, when you add it to a portfolio, it doesn't necessarily make the total portfolio more volatile. In fact, historically, what you see is you get higher returns without significantly increasing your risk. And that's a beautiful thing when building a portfolio. I liken it, it's a little bit like adding spice to food. If you add a little bit, it makes the food taste better. If you add a lot, for sure, your mouth will burn and it will be risky. That's true with Bitcoin as well. From a short-term perspective, it's absolutely true that if the market pulls back, Bitcoin, which is a risky asset, tends to pull back as well. But what the data shows is that it historically recovers faster than equities. In other words, it gets back up to even faster than stocks do. And then it continues to outperform equities as it rebounds. So if you have a view of the market that's, I'm investing for the next week or the next day, it's not a very good hedge. If you have a view of the market that you're investing for the next year or the next 3 years, it's historically been a very, very good hedge and a very good way to, again, get those higher risk-adjusted returns. So it comes down to your time frame. The biggest risk in crypto, bigger than regulation or volatility or tech risk or adoption risk, the biggest risk in crypto is behavioral risk. And when you start going above 5% Bitcoin, historically, Bitcoin becomes the driver of what's called the maximum drawdown of your portfolio. That's when your portfolio goes from looking great to looking pretty poor during a big market pullback. And in our experience, when Bitcoin starts to be the tail that's wagging the dog of your portfolio, people panic when you have pullbacks. Again, this is a very volatile asset. It's had multiple 50% plus pullbacks. If you put too much of it in your portfolio and we get another one of those pullbacks and you sell at the bottom, then you've done real harm to your portfolio. So you need to have just enough that it influences your portfolio, but you're not going to panic if the bottom falls out, right? I can withstand a 5% loss in my portfolio. We see that in the S&P 500 all the time. I don't panic. But if it was 30% of my portfolio and it had a massive drawdown, I might have a bad behavioral action. And so that 5% limit is designed sort of to protect against that feeling you get in your gut when you have a big market pullback. And that is why we think that's an appropriate level. If you're thinking about crypto today in a serious format, you're ahead of most investors in the world. That, to me, is your alpha opportunity. Do you really want to conflate that alpha opportunity with trying to pick Ethereum, Solana, etc.? It's very hard. I'd rather get the big trend right than try to focus on the specifics. But I know that people love to go and try to chase things, particularly in crypto. If you talk to people who love Ethereum, they only love Ethereum. If you talk to people who love Solana, they only love Solana. I do this 24/7, 365. I can't tell you exactly how it's going to turn out. So just buy the basket. Make sure you get that 250x return. I love that analogy.
Bitcoin's remarkable performance with a historical annualized return of 100% attracts investors who often build leverage and drive speculative cycles. These cycles, characterized by booms and busts, differ from traditional markets in one key respect. Bitcoin consistently establishes higher lows after each correction, underscoring its resilience and growing adoption. As Bitcoin matures, its risk profile evolves. The early days of existential uncertainties have given way to a more stable environment. Institutions, financial advisors, and mainstream investors now participate in the market, compressing its volatility and enhancing its appeal as a legitimate asset class.
It's because it's so early and it's so promising. Let me unpack that a little bit. Mostly, traditional investors don't get involved in markets until they're relatively mature, right? Until they're public equities, and these are companies that have grown up and maybe have $100 million in revenue or more, and they're well established. Crypto opens that up. You can invest in a protocol that is just emerging today. Indeed, when Bitcoin started, it was publicly traded before basically anyone knew what it was. So you're getting in early. And then these are very exciting, promising technologies that are going after very large markets. Bitcoin is the best performing asset of all time. It's compounded at 100% per year. What happens in markets that go up a lot? And this explains the cyclical piece of it. What happens in any market that goes up a lot is investors start building leverage on top of their positions. They start maybe over-investing. They get overexcited and overhyped. We see this outside of crypto. You see this in any technology area. It goes from skeptics to mainstream to overhyped, and then there is a reset. The same thing happens in crypto. Because it performs so well, it attracts a lot of money, and the market gets overheated, and then there is a pullback. But the important thing to remember is we've had multiple of these sort of boom and bust cycles in crypto, But when it pulls back, it doesn't go back to where it started. There's a shift from speculative to more fundamental investors. That's absolutely true. And there are more types of investors coming into the market, right? Institutional investors, financial advisors, those didn't exist in the market beforehand. But there is also just the reality that it's becoming less risky over time. 10 years ago, there was a reasonable chance that there was some unknown in crypto that would cause it to not work in the market, right? There was something that would blow up in the space. That no longer exists, right? We've now been around for 15 years. The likelihood that crypto goes to zero has been dramatically reduced, and that naturally compresses the volatility in the market. I think blockchain is a fundamentally transformative technology, one of our most important technological leaps. It can be applied to do many different things. Bitcoin uses blockchain to create a public form of money, a digital gold. And I think it's one of the most important financial innovations in a long time, has plenty of room to run. But there are other things you can do with blockchain. If you look at Ethereum, they're using blockchain to create sort of a new internet for money and finance and social networks. That's very exciting. I think about Ethereum as a technology investment, like it almost belongs in the NASDAQ. People are building applications on it like you would build an application in the Apple App Store. So if Bitcoin is money or gold, Ethereum is technology, sort of belongs amongst the Mag 7 tech stocks. I think that's a good way for investors to start thinking about this asset class. So the first level is the US already owns about 200,000 Bitcoin from seizures, particularly in the very early days of Bitcoin from Silk Road in 2013 and 2014. I think the odds that we keep that Bitcoin instead of selling it are extremely high. I would say above 90%, right? Almost a certainty. And that's really important. One of the reasons Bitcoin traded sideways for much of 2024 is that governments were selling their Bitcoin around the world. So will we keep that Bitcoin? Almost certainly. The likelihood that the government starts buying Bitcoin, I think is something like 25%. I should put a note on that. 25% doesn't sound like much, but that is an extraordinary fact compared to where we were.
Is it already priced in?
No, I think it's not priced in at all. I think if the US government's not one bit. If the US government starts buying Bitcoin, I think you're looking at Bitcoin at $500,000 or $1 million a coin within, a period of a year. Because it won't just be the US government. If the US government is buying Bitcoin, you can believe that nearly every other country around the world is going to buy Bitcoin. And if that happens, the supply demand imbalance will be so large that I think it'll put past bull markets in Bitcoin to shame. So the fact that I'm talking about there's a real chance we could see this is an extraordinary fact. And I don't think it's priced in any way into the market.
Matt highlights blockchain as a groundbreaking innovation with applications beyond Bitcoin. While Bitcoin serves as digital gold and a decentralized form of money, Ethereum powers a new internet for finance and social networks. Comparing Ethereum to tech giants like those in the NASDAQ, Matt envisions its role as a platform for developers to create transformative applications. A fascinating aspect of Matt's discussion involves government ownership and potential purchases of Bitcoin. With the U.S. government already holding 200,000 Bitcoin, the likelihood of retaining these assets is high. The possibility of governments actively buying Bitcoin could create a supply-demand imbalance, driving its price to unprecedented levels, potentially exceeding $500,000 per coin.